Good afternoon, everyone. Ron Bullis here, the founder and CEO of Lifeworks Advisors, and welcome to another one of our client market updates. People are just joining the room here, and we are just getting kicked off. If you're new to one of our market updates, you'll notice that there is some menu options for you. I don't have audio feedback on this platform, so if you want, feel free to type a question in the chat message. It comes right to me. I've got a feedback monitor here. I will try and stop and answer those questions during my presentation. Today's market update is going to be a little bit shorter, more compressed than last month's. We're going to talk about oil prices and how the Iran war is impacting those. We're going to look at some of the key economic indicators as we normally do. And then I want to talk a little bit about the general broad market indexes, what's been going on year to date, zoom out a little bit. And then I'm going to close by talking about what's coming in Q2 for the Lifeworks life-driven planning system, where we're going to be talking about your risk management and your tax planning. So a couple of financial planning items at the end, along with Q&A. So just to make sure everybody can hear me well and that you know how to ask me a question, take a second and in the chat message, throw me an emoji, wave hi, say hello. Just make sure you can hear me fine and that you have it so that you know how to ask questions as I'm going through my presentation. Awesome, Lex, good to see you. Great. Okay. So let's jump right in here. All right, I gave you our agenda already, but here it is again. Key economic updates. We're going to talk a little about the markets. Now I always put this in quotations. I'm not going to cover every index or every facet of the market, but just some really key major ones. And also going to answer a couple of questions that I had from the last market update today. All right, so let's jump right in. I'm going to make the screen a little bit larger so it's easier for you guys to see my graphs. There we go. One of the most important things to understand is the impact of inflation over time. I can't overstate this enough. In 20 years now of being a financial advisor, far too often, both professional advisors and clients view the risks to their financial plan or their financial future as mostly being market volatility. Markets going up, markets going down. What happens to my life savings if a major market event happens? And while there is a risk from a timing or a sequence risk there, the real risk that all of us face is that every year, everything we're going to need to live on is going to cost us more. Now, that's just a historical reality. In theory, we could see deflation and things could cost less in the future. There are, Elon Musk would be an example of somebody who's predicting that AI is going to make everything less expensive in the future, and it's going to fundamentally change everybody's lifestyles. That could be a positive outcome for everybody. It could be a possible scenario. But inflation is the silent killer that erodes our purchasing power. I have 3 young ones still at home, grocery shopping, buying groceries. Clearly, inflation is still real and is still there. So we are constantly looking at and evaluating the soundness of your financial plans and your investment strategies, thinking about the real risk, which is that everything you're going to need to live on is going to cost you more than it does today. So some good news as it pertains to inflation. So this is looking at it on a long-term basis. If we look at a shorter term time run, we had massive inflation in the last few years of the Biden administration. And now in this first year of the Trump administration, this isn't political, it's just me stating the facts coming out of the Department of the Bureau of Labor Statistics. Inflation, the rate of change on a year-by-year basis has slowed considerably, but it hasn't stopped. So while politicians on either side of the aisle, depending on who's in power, are going to take some kind of victory lap and tell you that their policies are containing or constraining inflation, I want you to know that pretty much every political regime that we've had in my lifetime, and even when I look back in history past that, has allowed the cost of goods and services, i.e. inflation, to continually every year erode our purchasing power. So the rate of change has slowed. What we're seeing is the rate of change here on this graph, looking back over the last 5 years. This is a cumulative impact of inflation over time. So the last 5 years, CPI has grown at 4.5% a year. Now, in certain things like beef, groceries, energy prices, things like that, it's been far in excess of that. But the important takeaway from this graph is that it does appear that the rate of change on an annualized basis for the cost of goods and services seems to be normalizing and holding steady. Now, that's better than having a significant increase year over year, right? And in some regards, even if we knew that inflation was going to be just consistent at 2.5 or 3% a year, well, I would still say that is one of the greatest risks to someone's long-term financial plan. At least if it's consistent, it makes it easier to plan around and to plan for than when we have high variability from year to year. So some good news on the economic front. From last month to this month, we see continued signs of the rate of change slowing and the overall impact of inflation having a better outlook than it did previously. Now, that being said, the big one to talk about, and there's a lot of news headlines out there about this, so I'm not going to talk about anything as it pertains to the war. I just put on the slide here the Iran war and oil prices because there clearly has been a direct correlation. So what we're looking at here is the price of WTI. It's a price of a barrel of oil. And I wanted to first take a larger kind of macro view over the last 30 some years of where prices have gone. So we see some pretty high spikes around 07, 08, then it normalized, came back down, then it grew, and we've seen some ups and downs. 2022, or roughly the kind of start of the Ukraine-Russia war, we saw the oil prices skyrocket again from that on concerns of global geopolitical tensions causing disruptions. Prices came back down. But here's what we're living with right now. When we look at January at the beginning of this year, where a price of a barrel of oil was, which drives into the price of gasoline and airplane fuel and things that we need for energy, we're almost, not quite, we're almost to a doubling. So when we look at inflation, and I just said in the previous chart, hey, it's some good news on the inflation front. We're actually seeing inflation, the rate of change normalizing and leveling off. Well, very next slide here is potentially some coming bad news. Oil is an input in almost every sector of our economy. So pretty much everything that's plastic, everything that gets created, or I shouldn't say everything, a very significant portion of our consumer goods and services rely on oil or some derivative of oil, right? Whether it's being shipping, diesel oil prices, airplane fuel, whether it's plastics, whether it's the production of goods and services. So however long this spike in oil lasts is likely going to start having a knockoff effect, downstream effect to the price of goods and services. I don't know if that'll translate into seeing the consumer price index actually being adjusted upwards, but something that's as major of an import and a economic factor as the price of oil, I would expect it over time to start showing up in the price of goods and services. Yeah, John, really great point. Fertilizers, one that we don't think about a lot, very much dependent on oil products. It's a derivative of that. So another quick one here, the price of a gallon of gasoline. Probably everybody's felt this. If you live in a state that has even higher gasoline prices, scale this. This is looking at the US national averages from the beginning of January of this year until today. So not a doubling here, but definitely a significant increase in the price of a gallon of gas at the pump. I fly a lot for work, so does our team, and the price of airline tickets and some of these things are already starting to reflect some of the expectations around the cost of oil and what it's going to not just cost to get it out of the ground, but more actually the cost of shipping it and the security concerns getting it here. So this is a major economic update that a month ago we weren't talking about, and here we are talking about it. Is Lifeworks changing any of our investment strategies because of this? No. I'll explain that at the end of my presentation, how we don't react to things like this. But this will inform over time how we set our clients' financial plans up. And your financial plan is the basis and framework for how we allocate your assets and build your individual investment portfolio. So over time, there could be some shifts, but there's no, trading aspect like we're trying to either make money on this increase or we're trying to hedge against it or something like that. So there's no major decisions or things happening in our investment portfolios for our clients because of this. Jeff's question about what percentage of tariffs are borne by the consumer. I'll answer that one in my Q&A. There's a little bit more involved in that one, so I'm just going to pin this one here. Perfect. Okay. I didn't forget about that one, Jeff. All right, moving on, we're going to cover a couple more economic indicators that I believe are important. This is the U.S. unemployment rate. This is the broad measure of unemployment. What we still see here is we see a little bit of an upward trend in the unemployment rate, but not much. So historically speaking, when you see unemployment rates below 6%, it's considered to be full employment across the economy. Now we might have to adjust that to maybe 4% or something like that, but unemployment remains persistently low, which is a good thing. Now, the other side of that, and I'll have some charts and graphs and actually spend some time on this next month, is going to be looking at labor market participation rate. Because when people drop out of the labor market, either because they can't find the job they want or their job's being disrupted by technology like AI, or they're retiring out, the size of the labor market is one of the key functions of deriving the unemployment rate. So a persistent unemployment rate doesn't always mean that we have a really healthy, robust economy. There can be other things going on that would show some signs of weakening the economy or some economic indicators that we would want to be watching. So next month, I'm going to talk a little bit about the labor participation rate, how some of these numbers are calculated, get into a little bit more nuance on it. But the good news here, and I still believe it's good news from everything that I can look at, see, and the people much smarter than me that I listen to, the persistent unemployment rate is definitely a good thing. If you're not a business owner looking to hire people, the labor market is definitely still challenged there. And that's a good news for consumers in that regards, because it should continue to translate into increasing household wages. All right, another one, federal funds rate. Just today, we saw the FOMC, Federal Open Market Committee's statement that they're holding the target federal funds rate unchanged. And we've had a pretty significant flip from where we were even a year ago to today in regards to the number of Federal Reserve board members that anticipated cuts or anticipated increases in the Fed funds rate. The majority of them now expect to hold the Fed funds rate constant for the rest of this year. And then a portion of them see some decreases next year, and one of them believes that they'll be increasing interest rates. So when we look at their views on where they see the Fed funds rates going, the takeaway here is we are in a holding pattern for now. No reduction in interest rates from the Fed, no increase in interest rates. I just consolidated last month's slide where I walked through US Treasuries and mortgage rates and then compared them. I just actually consolidated it all into one slide. So last month, here's where we were sitting with some of the major yields and the 30-year mortgage rate. We're about a little over 6% on the 30-year mortgage. The 10-year Treasury average was about 4%, and the 2-year Treasury was 3.4. I want to just do a quick review of that because here's where we're sitting today. Mortgage rates inched up just a little bit, barely noticeable. 10-year Treasury yields are up a little bit, as well as the 2-year yields. So what that means is there's not a relief for, let's say, homeowners in terms of people that are looking to buy their first home or they're looking to refinance. Rates have held steady. The flip side of that, the good news is for people who are savers that have money invested in US Treasuries or in interest-bearing cash accounts, our interest rate yields have remained pretty steady or even maybe ticked up slightly from last month to this month. Something we talk about a lot, the Shiller-Cape ratio. This is a measure, a broad measure of how expensive US equities are. Now you could apply this to any type of equity, but generally we're looking at this as it relates to the S&P 500, the 500 largest stocks in the United States. What this is doing is it's saying, what is the price of what price to earnings, sorry, my brain's moving a little slow today. What is the cost of buying $1 of earnings in the company? So CAPE stands for the cyclically adjusted price to earnings ratio. So adjusting the earnings of companies for inflation and then looking at that relative to the price of the stocks. What this is telling us, the takeaway here is the historical average, when we look at this on a long run, right, is about 27. We're currently sitting at 38.8. There's only been a couple times in history where stocks have been more expensive relative to their underlying earnings. Here's the full history of it here. So we got December of 99, which would have been the dot-com bubble. And then we also have the 1929, 1930 period, which was the start of the Great Depression. Whenever I show this chart, I always have to put this caveat. No, we don't believe there's some impending market crash. Could the market have a significant pullback? Yes. But what we do use this data for is to help us think about and understand what we should be expecting from future returns on equities. Here's what I mean by this. If I'm looking at this graph right here, and I see that the price of a stock is high relative to the average amount of earnings, right? So price to earnings ratio is really high historically. That would lead us to make an assumption that the future returns on equities are likely going to be lower than the previous year's returns on equities. So over the last 10, now almost 15 years, we've had probably the best bull market, the best positive rates of return on US equities that we've ever had in the history of the stock market. It's been an incredible run. As we look forward, which we have to do when we're doing financial planning for our clients, for you, we're not trying to time the market, but we do have to make some assumptions. If we're holding X amount of dollars of US equities, what do we think a reasonable rate of return is to expect from those? So when we look at the Shiller CAPE ratio, one of the things that helps our team do, and we're thinking about this globally, not just for a specific client, but globally, it helps us set some of our target rates of return for the different types of assets that we're holding for our clients. So if we build a financial plan for somebody and that financial plan requires that they have an 8% rate of return, just making up an example, well, we would use this as one of the data points we're looking at to say, do we think it's reasonable that equities are going to be able to sustain that type of a rate of return? And when we see higher CAPE ratios relative to lower CAPE ratios, when the market is more overvalued, we tend to err on the side of caution and assume that we're going to see a lower average rate of return from equities over time. Now, why would we make that as our decision from something like this? Well, because it's the safer of two errors. If we just assume that the market's going to continue giving double-digit rates of return on equities like it did for the last 10 and 15 years, right? And then we're wrong about that assumption, well, that's a negative impact to your financial plan. If we assume future equity returns are maybe going to be slightly lower than they were in the past, not saying, death and destruction to the US equity markets, but just maybe a lower average return. And let's say we're wrong. Well, that's actually a positive outcome for your financial plan. So when we're thinking about this and we're using these types of data points to influence how we put together our investment philosophy and our strategy, we believe it's safer when we see something like this, which has been a long time trend now, right? To assume that future returns on equities are going to be slightly lower than historical returns on equities. And we're factoring that into your financial plans because it's the safer of two unknown outcomes. So that's how we're using something like this. So there are probably a lot of people out there on the internet that you could find that would point to the CAPE ratio and then say you should be selling all of your equities and buying, gold and guns and stockpiling food. Okay. That doom and gloom that the prepper side has been out there forever. Little PS for those of you that have known me a while or watched my videos, I do think it's wise to be prepared for natural disasters, major market pullbacks, but not to the extent of selling everything, buying gold, putting it all in food storage in your basement or something like that, right? So we're not using this type of data point and this economic data to say, hey, the market's going to crash, we should get ahead of it. but we do use these to help us inform how we think about future returns on equities, so we're making better decisions for our client, right? Yeah, John, you put that right. If you're right, we're good. If you're wrong, we're golden. Correct. That's maybe a more succinct way to put it. Okay, let's just talk a little bit about the markets year to date. I always hate what I call spaghetti line graph charts, but I think this one is interesting. So what I'm going to do is I'm going to look at year to date, 1 year, 5 year, and 10 year, because we get questions. I don't personally get much of them anymore, but they do filter up through our advisors that are talking with a lot of prospective clients who are looking at joining Lifeworks, and they'll say, why don't you guys hold emerging markets, or shouldn't we have more fill in the blank international equities in our portfolio or something like that? So it's really important when we talk about the markets. What I'm actually looking at here is I'm looking at equity markets plus Bitcoin. Now I put Bitcoin on here because I think it's the proxy for a type of asset class, digital assets, cryptocurrencies, some people call them, I call them digital assets. I think Bitcoin's probably the best proxy for that, right? So we have gold and Bitcoin, which are not equities, but they are broad asset classes that we do think have a place in most of our clients' portfolios, and a lot of people already own them. So what we're going to do is we're going to look at it really close, and then I'm going to zoom back and I'll make a couple of observations about what's going on that hopefully for people that listen to this either today or watch it later on YouTube are going to answer the question of, well, why don't you own more in this sector? Or I've been seeing on the news that emerging markets are killing it this year. Like, why don't we own more of it? Okay. So on a year-to-date basis, gold is still the top performer, followed by emerging markets, then followed by international developed, which is the gold colored line in there. And then the Russell 2000, which is small cap stocks. And then the S&P 500 is negative on a year-to-date basis. And then Bitcoin, which is really, really negative. Okay, so this is what's going on today. S&P 500 down, led by a lot of the companies in the tech sector. So there's conversations about how AI is eating the software industry, is going to cause a lot of issues there. I think that's probably true. The mega companies, the mega cap companies that dominated the returns of the last 10 years have now been underperforming year to date small cap companies. Now, on a long-term historical basis, small cap has tended to outperform large cap over time. But the last 10, 15 years, small cap and value stocks have been underperforming relative to the S&P 500. So let's look at a one-year basis. What we see on the one-year basis is a similar trend in terms of the stack ranking of performance. But on a one-year basis, the S&P 500, which is the royal blue line, is significantly positive. So yeah, the start of this year hasn't been fun, but when we zoom back out just a little bit longer, add another 9 months to the picture, so at 3 months, and we just zoomed out now to 1 year, we see the S&P 500 still having double-digit returns. Now, small caps outperforming, international outperforming, emerging markets outperforming, and gold still at the top of the food chain here. But what about 5 year? Most people, if they would have been asked, 5 years ago, what do you believe the best performing asset class is going to be? I would have bet very, very few people would have picked gold. I think a small group of people would have picked Bitcoin. I think a large number of people would have picked varying different types of investments, real estate, international, whatever. They would have been all over the board. But if we just rolled back and said 5 years ago from, actually the data is from yesterday's close. So 5 years ago from yesterday, and we bought gold, we'd likely be up almost 200%. S&P 500 would be up 70%. International developed, 50%. Emerging markets, 30. Bitcoin, 27. Small caps, 20-ish, right? All positive rates of return, all really good when we look at it historically. Well, what about 10-year? Well, on a 10-year basis, gold still outperformed. Roll back 10 years. Would anybody have predicted that? Probably not. What is this? What am I getting at here? Well, I'm going to show one more chart, and then I want to give a philosophical kind of take about how we think about investment strategies. And I see a couple questions popping up here. I'm going to scroll down and see them. Someone's asking where Bitcoin is. Hold on. There's Bitcoin. So what we're looking at here, here's the markets on a 10-year picture minus Bitcoin. Here's the total return when we add Bitcoin to the same graph. It's almost an 18,000% rate of return. Now, I'm not saying everybody go sell everything and buy Bitcoin. I am not going to pat Lifeworks on the back for holding Bitcoin in our clients' accounts, or it's just something we try and do where appropriate. My point here is if we jumped back 10 years, would any of us have said Bitcoin's going to have not only the best performing asset class, but by magnitudes and magnitudes and magnitudes? Probably not. Now, what we can see is the last 5 years, and even in the last couple of years, right? Bitcoin still had kind of a meteoric rise. And then the last 2 years, it's been falling off last 18 months, right? It's very much a significant down market if you bought your Bitcoin in, say, 2024, 2025. So why do I think this chart is important? Well, we get questions regularly from our clients and from prospects and from other advisors that are looking at joining Lifeworks. I believe the Japanese stock market's going to outperform the US, and why don't you guys hold, I'm being a little facetious here, why don't you guys hold more of that? Well, nobody can predict with certainty which one of these asset classes is going to outperform. You can't. And most people in our industry over the last couple of years that have heard me speak at events or have looked at some of Lifeworks investment strategies have said, oh man, why do you have gold in your clients' portfolios? That's such a outdated relic. And then there's the flip side is other people like, oh, gold's the only real asset. You should have all of your clients' money in it, right? The takeaway here is it's really, really important to look at our investments and the timeline and the context of when we need those dollars. So I will oftentimes feel, or you might feel like I'm constantly saying the same thing, and maybe I am, but it's worth repeating. How Lifeworks invests our clients' money following a liability-driven framework. We call it life-driven investing, as we match the right type of investment that has the right volatility parameters to it with when we need to spend the money. So the money that a client needs tomorrow isn't sitting in Bitcoin. It's not sitting in the S&P 500. It's generally sitting in either a money market fund, a high yield savings account, or short-dated US treasuries. Money that we don't need to spend for 10 plus years out into the future. Let's make it a little bit easier to see the graph, right? That green tranche, that last segment, the growth segment, well, those are all things that should hold gold, digital assets, equities, and perhaps a diversified basket of equities between US equities and international, et cetera. So the reason I wanted to talk about the markets and use this kind of like, I'm going to rewind here, year to date, step back a little bit. Yes, year to date, emerging markets have been trouncing the S&P 500. Well, on a 1-year basis, emerging markets have as well. On a 5-year basis, the S&P 500's beating them. 10-year basis, et cetera. It's because trying to speculate on which asset class is going to be the best performer or listening to people that do is a fool's errand. Now, when we look at data around the market returns and we keep stepping back, right? Bitcoin isn't that old, so we have to drop Bitcoin off the conversation. But if we step back 20 years, the rate of return on the S&P 500 has been 4 times that of the emerging markets and about 3 times that of the international developed markets. So answering a question for all of you Lifeworks clients around why your portfolios probably have very little exposure to international or emerging markets is because when we look back over 10 years, 20 years, 30 years, 40 years, 50 years, and a long duration of time, the US equity market has outperformed the emerging markets, the international markets quite handedly. But we do believe that there is a place for them in some of your portfolios and with a right thought about sizing. Just like we believe that you should hold gold, and if it's something you're comfortable with, a small allocation to Bitcoin. By the way, a small allocation to Bitcoin in your portfolio alongside of US equities, if we look at it and do some back testing, has a dramatic impact. Now, there is valid reasons to be concerned about something like Bitcoin. We are not a Bitcoin maximalist. I don't think it's going to replace the US dollar. I don't think it's grandmother's elixir, that it's the best asset class to own. I think there's challenges to it, but it clearly has, in our opinion, a small place in your portfolio. So when we're looking at things again, guys, we're not looking at this from a how do we time the markets? How do we look at what's going on in Iran and oil and say, oh, we should be selling this and buying this? All of those things are short-term decisions that are made in hindsight and likely are going to be wrong 5 years from now or 10 years from now. In fact, I was talking with one of our advisors and a prospective client the other day. They asked me to hop on a call. It was really fun. I haven't done this in a while. And this individual is asking me questions about the market and how they've been talking with their current advisor about stuff. And I said, look, the data is actually clear. The S&P Global tracks this. 95% of all actively managed investment funds underperform their benchmarks, because we can't see into the future with perfect clarity in a crystal ball. What we can do is we can let things that are long-term trends, economic ones and market ones, drive how we're making our decisions for allocating assets and how we stay invested regardless of the market noise that's going on. And that's what we're doing today. So in recap on the economic stuff, and then I'll answer some questions. I said this is going to be a little bit shorter of a market summary. I'll jump into the Q&A next, but recap. Inflation seems to be holding steady, although that could very much change depending on the price of oil and how long we see the sustained increase in the price of oil, as that will back filter into almost everything. Plastics, which go into medical devices, oil, which goes into fertilizer and agriculture products across the board, transportation, et cetera. So it could be that that leading indicator right now will turn into increased inflation. Unemployment is still persistently low, which is a good thing, as long as you're not the business owner trying to hire people where you're going to have to pay them more. So overall, low unemployment is generally good for the US consumer for wages. Interest rates are pretty much static from a month ago, small changes. And what we see in the market is some really significant noise right now, right? S&P's down, software and tech is definitely getting hammered because of AI. Short-term kind of switch in what we've seen the long-term trend to be, where emerging markets and international are outperforming the S&P 500. We don't think that's likely going to be the case again over a long period of time, because when we look back 10 years, 20 years, 30 years, 40 years, that just hasn't been the case. So we're going to continue to do what we've always done, which is build investment portfolios based on each individual client's financial plan, hold the right amount that we need for your financial plan in each of the right segments, so that we're not selling off assets that are down in the market. We're positioning with strategy and with foresight for how to generate that consistent income. And then we're turning off the news as much as possible, because most of it is doom and gloom, regardless, again, of which side of the political aisle you're on. It's mostly noise and can be ignored. So with that, that's the end of my presentation. I have a couple of financial planning things that I wanted to talk about. I'm going to take a couple of questions that are in here now. So if you have any questions on my current presentation or something you've seen, heard in the market, I'm happy to take those. And then before we sign off, I'm going to talk about what's coming in Q2 with our life-driven planning system, some of the topics that our advisors are going to be talking with you about, and then also a couple of things that I think are just maybe not talked about enough, but I wanted to mention them here. So I'm going to get to Jeff's question first about, did I find out what percentage of the tariffs are borne by the consumer? Jeff, I did not find a resource, and I did go looking. I almost included a graph on tariffs in this presentation. I couldn't find a resource that I really had confidence in the sources behind it. That didn't seem like it was maybe being too political. So it's still a little murky for me to get an answer as to how much of that is being borne by the consumer. So the default answer I'm going to have to give right now, which I'll keep digging because this is a great question, is that when we look at the inflation, if we do get granular and look into different like product categories of inflation, you might be able to see some of the tariff costs happening there, right? But it's really difficult to see, and I couldn't find a good source. So if anybody has one that is a apolitical or non-political source that is truly just economics and stats, I would love to see it. But Jeff, I couldn't find a clear picture that didn't have some kind of political bent to it or something like that. David's question, are Lifeworks advisors including Social Security benefit reduction potential and plan stress testing? What are your thoughts here? Oh, this is such a good question, David. Here's my thinking on it. Each of our individual advisors at Lifeworks might have a slightly different way of putting this, but I believe we all pretty much share this agreement. It's very, very unlikely that in the lifespan of the baby boomers, that we see Social Security benefit reductions to them. One of the largest voting blocks in America and one of the most active voting blocks in America is the baby boomer generation. So if you are over the age of 60, what we're generally across the firm telling our clients is that we have a high degree of confidence that your Social Security benefits are going to be there. Do I think a politician or a group of politicians might monkey with how they index it for inflation again in the future? Yep, certainly do. But each political party is deathly afraid of actually tackling the problem of Social Security insolvency because they don't want to lose potential votes from that voting bloc. That's my take on it. And I think it's been the case across a couple of different presidential administrations from both sides of the aisle, right? What we do know when we look at the Social Security Trust Fund is that there is going to be a lopsided number of people collecting Social Security retirement benefits relative to the employed workers paying in. It's not sustainable in the long run, meaning to say like my generation, I'm 44, so I'm considered an old millennial, but not quite Gen Xer. It's certainly not something I would include in anybody's financial plan who's under the age of 55. That's my personal take. I think most of the advisors here at Lifeworks share it. So when I run my financial plan and our financial planning software and Social Security is in there by default, I click a button and we turn it off. Social Security Trust Fund is projected to be out of reserves by 2035, 2033, depending on whose numbers you look at. And I just don't see anything coming out of Washington, D.C. on either side of the political spectrum that's willing to actually address waste, fraud, potentially reallocating where we spend money to actually funding the Social Security Trust Fund to where it would need to be to pay benefits to, say, Gen X, millennials and younger. So I'm not sure what age you are, David, but if you're over the age of 60, I think it's reasonably likely, and we would include Social Security in a client's plan as a default. Longer answer or a quick PS to this long answer to your question. Generally, our advisors are running your financial forecast without Social Security just to see what happens. But we don't, as a default, assume that your Social Security benefits are going to be reduced or taken away if you're a baby boomer or older. We just don't see that as being a very likely political outcome, and nobody's talking about that, right? So hopefully that answered your question there. Oh, John had a question for me about what Morgan Housel considers the most important and most difficult word in all of finance. Not sure you talked about this. I didn't cover this. And yeah, I'm just looking at my time on here. Let me save that one because I actually should put a couple of slides together for that. In fact, I completely forgot to put that into this live stream, and I should have. That one just jumped past my mind. But I will, I'm going to address that one in April because that one deserves a slide or two. But great question. So I'm going to put a pin in that one. So I will catch it on next month's market update. All right. I don't see any more questions in here right now. I want to talk about a couple of planning things. So Q2, the second quarter of every year, the focus at Lifeworks in our planning system is risk management and taxes. There's not anything necessarily magical to why I put risk management and taxes in Q2, other than in Q2, we're generally filing our taxes. And then I thought to myself, what's another topic that most people generally dislike as much as taxes. And I was like, well, risk management, insurance, and those types of things. So in Q2 of every year, our focus is going to be leading our clients through conversations around topics inside of risk management and tax planning. On the risk management side, I'm going to just give a couple of practical tips that I think are really, really important. You might have already talked about these with your advisor. So if so, like, great. If not, they probably will bring this up, or you can even bring it up with them in the meeting. Risk management is more than just insurance. There are some practical things to it. So when people hear risk management, generally, I think we think insurance, life, disability, long-term care, homeowners, auto owners, things like that. An area of insurance that I see most people, when I was an advisor serving clients, and I stopped serving clients directly 4.5 years ago, right, to just focus on being the CEO of Lifeworks and helping grow the firm. But one of the areas that I consistently saw clients underinsured or exposed was when it pertained to umbrella insurance. So as a general rule of thumb, I believe everybody should have an umbrella insurance policy that's equal to the total amount of assets you own. They're relatively inexpensive. I think I pay around $1,000 a year for my umbrella insurance policy. Now, why is it important? Well, we live in an increasing litigious society. If you have teenagers at home that are driving, or if you have young adults that are still living at home or driving one of your vehicles, great example here, right? You send your kid off to college and he or she is driving your car that's titled to you. Your kid goes to a party, has one beer, drives home, gets in an accident. There's alcohol in their system, right? Now, setting aside not wanting anything to happen to your child, but the practical knockoffs of that is that it's very likely that the person on the other end of something like that, their attorney is going to pick up on it and they're going to sue the owner of the vehicle. So where umbrella insurance comes in is it steps in and provides additional coverage that are beyond just the standard limits of liability that come with most auto policies, homeowner insurance policies, et cetera. For the price of an umbrella insurance policy, I think it's one of the best tools at minimizing the risk of something happening to you, to your wealth, excuse me. Another example is I have young kids at home still. We also have a trampoline in my backyard, right? Things like that. I hope to never have to use this, but when I think about possible things that could have a financial impact on my family, again, leaving aside the human element of it, just thinking about it from a financial planning standpoint, I believe that you should have an umbrella insurance policy that's equal to the amount of total assets you hold. And even if you don't have young kids anymore, or you don't have young adults driving your cars, I would still just have something like this because we live in a litigious society. And this becomes a mechanism with which a claimant could potentially receive a settlement, or your attorney fees could be paid, and it's not going to be financially detrimental to you. Umbrella insurance isn't just for somebody worth $10 million or $20 million. I think it's really, really important for a family with $2, $3, $4 million of total assets, right? To have. So from a risk management perspective, there's a practical one there. I want to give one other practical one on the risk management side that I run into a lot with people that are self-employed. Their business will own their vehicles. And generally, there's tax reasons for doing that. We call it our business vehicle, and so we take a tax deduction. But what can actually happen there if you're driving a car, generally speaking, let's say for personal use, or if your spouse's car or something like that's a business car and your business paid for it, you're actually opening up your business to litigation if there's an auto accident. So I see this all the time with business owners. That used to be one of my primary types of clients I worked with, was first generation entrepreneurs, family business owners. They would buy a vehicle through their business. Let's say it's perfectly fine. There's business reasons for it, but then they would use it personally. Spouse would use it. Teenager might drive it. They would drive it. Again, if something happens there, it's not just your personal assets they're coming after, but now you've opened it up to where they're coming after your business assets as well. So trade-off, you might pick up a small tax deduction, but you increase your risk. And when we think about wealth management over time, it's trying to help our clients make wise decisions in the management of their overall wealth. So we might accept paying a slightly higher tax bill because we don't get the tax deduction from me buying that vehicle inside the business, but we're also going to keep that separation between business and personal assets to try and improve the outcomes if there was some kind of accident, there was a lawsuit, or there was a claim or something like that. So a couple practical applications there on the risk management side. Everybody should have an umbrella insurance policy equal to their total assets, not your net worth, but your total assets. And if you have a small business and you are paying for your vehicle through your business, just be thoughtful. Maybe have a conversation with your advisor and or your insurance agent about ways to potentially make that a personal vehicle and insure it on the personal side. And if you have a work vehicle, which a lot of my friends are in industries that do constructions, trades, things like this, maybe try and minimize the use of that work vehicle for personal use, because while you're driving it, again, the bullseye is not just on you, it's also on your business. David's got a question around what are the portraits on the wall behind me? Love that. Let me see what other questions we've had come through here a second. I will happily share that because I love talking about it. I covered it in last webinar, but I'll go through it really quickly. Looks like Gwen's getting on Billy Graham, C.S. Lewis, Corrie ten Boom. Ooh, she knew Corrie ten Boom. That's awesome. Thomas Jefferson. Okay, Trevor, I've had a few clients ask me why we don't have a small allocation to small mid-cap stocks. So the question here about small and mid-cap, our main factor models, so we use factor investment selection methodology. I've covered that before. We tilt towards small companies, but we're not going and looking specifically for the smallest publicly traded companies or allocating specifically to companies that fall in that segment. Again, when we look at the objective that we're trying to accomplish, which is to generate a positive rate of return that outpaces inflation, right? That has a high degree of probability and consistency to it. We generally are looking at the S&P 500, using our factors to rank those. And then we tilt inside of that S&P 500 group of stocks towards companies that are smaller. So we generally don't have the mega cap companies in there, but we're not going out there and specifically allocating to small cap or mid cap as a specific asset class, generally speaking. Same reason I gave when I talked about gold, Bitcoin, and things like that, international emerging. The S&P 500 is probably the best broad market index of the US equity markets over time that has the consistency of returns to it and also tends to have the best performing companies in terms of dividend yield, profitability, things like that. So quick portraits on the wall. From my right, should be your left if you're watching me. Yellow one is Billy Graham. Red is C.S. Lewis. Blue is Frederick Douglass. F.A. Hayek, who's a Nobel laureate in economics, wrote a book called The Road to Serfdom. Bottom right-hand corner, it's a little hard to see, is Jordan Peterson. William Wilberforce, he's a reason why we don't have slavery in Western civilization. If you don't know who William Wilberforce is, Google his life story. It's fantastic. There's a great book about him called Amazing Grace, much worth the read. Corrie ten Boom, a survivor of the Holocaust, wrote a great book called The Hiding Place. And then Thomas Jefferson. Each one of those represents one of my core values. And so I had those done by a local unknown artist just for me to give myself the opportunity to share my values in that story with the people who are on video calls and live streams and stuff like that with me. Glenn, quick question at the bottom here. What's the difference between net worth and total assets? Great question. Net worth is your total assets minus your total debt. So total assets minus total debt equals net worth. So when I say total assets, I like to target an umbrella policies that are an equal amount to your total assets, because if you have debt and you're paying it off over time, right, we'll still need that same umbrella insurance policy amount, right? And in litigation, or if something happens, people tend to go after your assets and you still end up oftentimes with liabilities if you have a negative outcome in civil litigation or something like that. So the idea with an umbrella insurance policy is to protect or cover the value of your assets. Now, there are some people, and there's a valid argument to make, some states exempt IRAs, 401ks, and retirement assets from civil litigation, but it doesn't mean that an attorney on the other side that might be suing you is going to take that position. So an umbrella policy can also provide the funding to pay for the expensive costs of litigation if you have an event like that. Including house, cars, musical instruments. If you have a valuable musical instrument, we have a client that has a very valuable violin, just one that I know of personally, then yeah, that would probably be included in there. Would I go all the way down to, my appliances and my toaster oven? No, but I would look at reasonable things that have market value, right? Your house, your cars, your cash, stocks, bonds, retirement accounts, things like that. If you have some kind of collection or collectibles, I would put that in the umbrella policy too. Oh, yeah, though they definitely got some money. 2 harpsichords, 2 grand pianos, 3 manual organs, digital. Yeah, okay. So maybe that's something, put that value in yours. I'd also say if those aren't in your homeowner's insurance, another little note here is sometimes things like that are not covered by a homeowner's insurance policy unless they're specifically line itemed. So another quick little PS here, if you are holding currency, this is a risk management one, just made me think about it. If you're holding currency at home, so you've got mattress money, or maybe it's sitting in a safe. If you're holding gold in your home or silver, even if it's in a safe, it's likely not covered by your homeowner's insurance policy. So talk to your homeowner's insurance agent about it, but typically they don't cover those, even for things like fire or natural damages, because they're hard to prove that they're there. I used to have a client years ago that had multiple 7 figures of gold stored at his home. And when I said, you realize there's no insurance on that? He's like, no, I have homeowner's insurance. I said, let's call your agent. We called his agent, talked to him as though, yeah, he had a $25,000 maximum limit of liability on precious metals. Jewelry, same thing. If you have pieces of jewelry, wedding rings are a great example. Generally, you'll be required to get an appraisal on those to line item. They will add to your homeowner's insurance premium. My wife has her wedding ring on our homeowner's insurance policy. So yeah, let's say you have an expensive Rolex, or let's say you have a fairly expensive piece of jewelry. Again, your personal insurance policy, your homeowner's insurance policy will likely cover personal effects, but they're cautious with this if you have to make a claim, because what would stop somebody from saying, oh, I had a $25,000 Grand Mariner Rolex, or whatever. It's like, well, prove it. So it's something to be thoughtful about. In Q2, our advisors are going to be having some of these conversations and just, take some of these as kind of practical risk management things. Everybody's got a different level to what they would consider valuable. But if you have a wedding ring, a collectible watch, some jewelry, something like that, I would definitely talk to your insurance agent about itemizing each of those. And then I would keep an inventory of it. So pictures stored digitally, and then any appraisals that you have on them to prove that you're yours. Andy, I believe a litigant can't touch a pension, right? Not necessarily. I am no means a legal expert, but what I can tell you is just because something shouldn't be attachable or collectible in the event of a civil litigation doesn't mean that there aren't attorneys that are going to try. And it also doesn't mean that you couldn't still get an adverse judgment against you in some type of action like that. And yeah, you might still have money over here in an IRA or a pension, but the moment you take it out to put it into your checking account to spend it on something, they might be able to garnish it or get it that way. Generally, qualified retirement plans are exempt from the claims of creditors, generally speaking. So. All right, Trevor also added some color there. So ERISA, yeah, anything that's an ERISA plan. the Employee Retirement Income Security Act? All right, these are really good questions. I'm happy to hang out for a little bit longer if you have to jump. We appreciate you being here. All of us at Lifeworks love serving you and your families. We love what we do. We're honored and humbled that we get to walk with you through your life and help you manage your wealth. I'm going to hang out here for maybe another 10 minutes or so. Happy to answer any more questions about markets, financial planning, maybe play Stump Me with a topic. Otherwise, if we see the questions kind of peter off, I'll sign off here as well in a few minutes. You're welcome, PT. Just scrolling, making sure I don't miss any questions. David's question about any insurance company preferred for umbrella. If you don't own an umbrella insurance policy currently, generally, you have to purchase your umbrella insurance through the same company that you do your home and auto through. So my umbrella policy, the insurance company required that they had my home and auto and that they were linked together. So if you get an umbrella insurance policy, generally over $1 million, they're oftentimes going to require that you do it through the same carrier. So. Another thought here, because I just was remembered about this. I was talking with a peer of mine. She, a few years back, sold a firm about the size of Lifeworks that she had started and founded, really great financial advisor. And she was telling this story, actually made me go back and check mine because we have a 21-year-old. She was telling the story of one of her clients who sent their kid off to college with a family car. So another thing here, I talked about the insurance element of it. There is a worthy discussion to have about who owns your, let's say, adult child or even teenage child car. Like my eldest daughter, we had bought her a brand new car. She made the payments. That was the deal. We wanted her to have a good car with a warranty and not be getting the weekend call, Dad, my car's broke down. But because my name is on the title to that car, again, back to a risk management thing, she's driving it around, gets in an accident, they see that I own the vehicle, they're likely going to come after me. So if you're sending a kid off to college, or you have your kids sending your grandkids off to college, something that might be worth considering. I don't know that it works out for everybody or worth talking to, but definitely look at who potentially owns the vehicle. And it might be, from a risk management perspective, better to have the kid own the vehicle in their name and accept a slightly higher insurance premium than to keep the car in, say, mom and dad's name or something like that, and put mom and dad's assets at risk if the kid has some kind of car accident or some kind of an event. Something else to think about there. So, all right, I don't see any more questions coming through. Again, thank you guys for being here. I hope you found today's quick market update to be informative. In the next couple of days, our team will get it out, the recording with the links to the slides and stuff like that, as always. And from all of us here at Lifeworks Advisors, thank you for letting us serve you and your families. We love, love, love what we do. And I look forward to having you on another live market update next month. Take care.